On July 24th, four of China's biggest banks, including the largest bank on earth by total assets, stopped letting ordinary people trade something called paper gold. Not gold bars, not coins, paper. And the official reason they've given is almost boringly reasonable. But there's a second thing happening at the same time, 1,200 miles away in Hong Kong, that doesn't fit the boring explanation nearly as neatly. Today we're looking at both, honestly, what's confirmed, what's speculation, and where the line between them actually sits. I'm May, this is Behind the Market, and this is the story of two things China is doing with gold right now, and why only one of them is as simple as it looks. The official story, and why it's real. Here's the part that's fully verified, so let's start there. Gold had an extraordinary year. It hit an all-time high of $5,589 an ounce on January 28th of this year, after a run that took it from around $2,600 just 12 months earlier. Then it gave a lot of that back, dropping below $4,000 by June, close to a 30% pullback from the peak. That's the kind of swing that makes risk managers nervous, and Chinese banks responded exactly the way you'd expect. Some raised margin requirements as high as 140% on precious metals contracts tied to the Shanghai Gold Exchange, making leveraged retail bets expensive enough that most people would want out anyway. Then came the bigger step. The Industrial and Commercial Bank of China, the world's largest bank by assets, announced it would stop offering individual customers trading in these contracts entirely, effective after settlement on July 24th. Postal Savings Bank of China, Ping An Bank, and China Guangfa Bank all followed with nearly identical wind-down notices. Retail clients get three options before the deadline: close the position, liquidate it, or take physical delivery. Here's the but that matters. This isn't the first time Chinese regulators have done something like this. Back in 2020, a Bank of China oil product called Crude Oil Treasure blew up retail investors when oil futures briefly went negative, a structural flaw nobody had priced for. Regulators have been tightening the leash on leveraged retail commodity products ever since, restricting new Shanghai Gold Exchange accounts for years already. So a wild 30% swing in gold, followed by banks pulling the plug on a leveraged retail product, isn't a mystery. It's a pattern regulators have followed before, for a genuinely defensible reason. If this were the whole story, it'd be a fairly ordinary risk management footnote. It's not the whole story, because at almost the exact same time, China is walking retail investors out of paper gold. Hong Kong is doing something that only makes sense if a lot more physical gold is coming, not less. Point 2. What Hong Kong is building. In January of this year, at the Asian Financial Forum, Hong Kong's government announced a plan to expand the city's gold vault capacity from roughly 200 tons to over 2,000 tons within 3 years, a tenfold increase, alongside a new central clearing platform built in partnership with the Shanghai Gold Exchange. This isn't a rumor or a leaked memo. It's a public government announcement, confirmed in Hong Kong's own 2026-27 budget documents, and reported by outlets including Caixin and the South China Morning Post. Here's why that detail is worth sitting with. You don't build 10 times more vault space to hold paper contracts. A contract is a promise on a piece of paper. It doesn't need a climate-controlled room with armed security. You build that kind of physical capacity because you're planning for actual metal to show up and need somewhere to sit for years. That's not a defensive move. That's infrastructure for growth. So now you have two things happening in the same window: China walking retail traders out of a leveraged paper product, and Hong Kong building the physical infrastructure to become a much bigger real gold hub, with a direct settlement link back to the mainland's own exchange. Individually, each move has a clean, defensible explanation. Together, they start to look like two ends of the same shift, away from leveraged paper claims, toward gold you can actually hold or physically deliver. I want to be precise here, because it would be easy to oversell this into China is orchestrating a gold conspiracy, and that's not what the evidence actually supports. Infrastructure like Hong Kong's vault buildout takes years to plan. It was already announced back in 2024 in earlier form, long before this month's headlines. So this isn't a reaction to this week's news. It's a much longer, slower structural shift that this week's headlines just happen to be intersecting with. To understand why that structural shift matters at all, you have to understand something most people have never had explained clearly: how the price of gold you see quoted every day actually gets set, and why that price has broken before. Point 3. The history that rhymes. After World War II, The world built a system where the US dollar was the anchor currency, and the US promised any government holding dollars could exchange them for gold at a fixed $35 an ounce. Through the 1960s, the US spent heavily: Vietnam, domestic programs, maintaining global leadership, and printed a lot more dollars to do it. Foreign governments noticed the math didn't add up. More dollars chasing the same pile of gold in Fort Knox meant each dollar was worth less than the peg claimed. So in 1961, the US and several European allies formed the London Gold Pool, selling reserves whenever the market price rose above $35 to keep the peg intact. It worked for a while. Then France, under Charles de Gaulle, quietly left the pool and started trading dollars for gold directly. Others followed. What had been an orderly defense turned into a run on the pool's reserves, and by March of 1968, the pressure was severe enough that the US asked Britain to shut the London gold market entirely. When it reopened, the world had two prices for gold: an official $35 rate between central banks, and a market price that quickly moved past $40 and kept climbing. 3 years later, Nixon ended dollar gold convertibility for good. Here's why that history is directly relevant today, not just a trivia detour. Paper gold works on a similar principle to that old peg. A bank sells you a contract saying you own an ounce, redeemable at the going price, while the actual metal supposedly sits in a vault somewhere. Almost nobody ever asks for the physical bar. They just want the contract price to move, which means, structurally, more paper claims can exist than there is metal to back them, as long as everyone doesn't ask for delivery at once. Nobody publishes a reliable count of exactly how many paper claims exist per real ounce in today's market. That's the same shape as 1968, an official quoted number, and a separate question of what's actually sitting in the vaults. Point 4. What the biggest buyers are actually doing. If you don't trust anyone's narrative, including mine, here's a test that doesn't rely on interpretation. Watch what the largest, most sophisticated buyers in the world are doing with their own money. According to World Gold Council data, central banks bought a net 244 tons of gold in the first quarter of this year alone, and they were doing it during a historic quarterly price decline, buying into weakness rather than chasing the January highs. That's part of a multi-year pattern of central banks steadily building gold reserves, often funded by trimming other holdings. Institutions that have spent decades comfortable holding paper promises have been adding physical metal at a notable pace. That's not proof of anything dramatic on its own, but it is a real, verifiable signal about how the people with access to the best information are actually positioning, as opposed to what any single video, including this one, tells you to think. Bringing it together, honestly. So where does this actually leave us? China's paper gold shutdown has a genuine, well-precedented explanation, protecting retail investors from leveraged losses after a wild price swing, following the same playbook regulators used after 2020. That part isn't a mystery, and I won't pretend otherwise, but it's happening alongside a real, independently confirmed, years-in-the-making build-out of physical gold infrastructure in Hong Kong, and alongside a genuine multi-year trend of central banks adding physical gold to their reserves. None of that proves a dramatic near-term event. What it does show is a structural preference, building slowly, for owning the real thing over owning a claim on it, and that's worth understanding on its own terms, without needing to dress it up as an imminent crisis to make it interesting. What to actually watch? Two things are worth tracking if you want to see whether this structural story keeps building. First, any meaningful, sustained gap between the quoted paper price of gold and what people are actually willing to pay for physical delivery. That gap is currently small, but it's the exact signal that preceded the 1968 break. Second, keep an eye on central bank purchase data each quarter. A continuation or acceleration of this buying pattern would reinforce that this is a structural shift, not a one-quarter blip. This isn't financial advice. It's the mechanism worth understanding before you make a decision that depends on it. Two stories, one very reasonable and confirmed, one genuinely structural and still unfolding, and the honest version doesn't need to collapse them into a single dramatic thesis to be worth 20 minutes of your time. If you'd rather understand the real mechanism than get the version dressed up for maximum shock value, that's what this channel is for. If that's useful, subscribe, and I'll see you in the next one.